So today I'm going to do the UK stocks that I've been buying recently. I'll go through these stocks that I've been buying in the last few weeks, and it just keeps the transparency up so you guys know what I'm buying and selling and not disappearing in the YouTube scene when this bear market's going on, or potentially stop showing my picks and maybe just switch into what's going on, macro videos. I'm still going to stay here even in the bear market showing what I'm buying, because after all, normally in a bear market those are the best buying opportunities. So I hope you enjoy the video and we'll get started. And just on a little bit of a side topic, I know people have asked for S4 Capital video because they reported earnings this week, which were really good. Catebox brought earnings out this week and their earnings were really good. And there's a few other stocks that have brought earnings out and people are asking me to update on them. The only problem is, unless it's something crazy that's happened, it's very hard to do an earnings video for every single stock that I own. I normally only do it when something surprising in a good way or bad way has happened. But if you do want to see an earnings video on the stocks that I do own, I do always post that on the Patreon. So if you do want to join that, link is in the description. There's 2 exclusive videos a week on there, one of them being a review of earnings where S4 Capital and Catebox will be mentioned this week. So there's 8 extra videos there a month at least. There's a Discord with 600 members to talk to and I'm on there, and that's where I post my in-time or real-time buy and sell alerts. If you want to join that, it's £5 a month, which isn't too bad at all. Price of a pint, or if you go to Wetherspoon, it's potentially 2 pints. So yeah, it's there if you want to join. We're getting stuck onto the first stock, which is Airtel Africa. So Airtel Africa is a telecommunications and mobile money business that operates in Africa, and it's very well diverse in the countries that it operates in. It's not got really one country that makes up massive amounts of revenue for it. Now the telecommunications is key because what we have in what we have in Africa is we have not really the big adoption to 4G yet, and there's not really a big build up of Wi-Fi. So 4G comes one of the main things that people use in Africa. So there's the 4G scale that's going on at the moment, and then you think potentially further down the line the 5G potential as well. But also the other part of the platform's key, which is mobile money. So mobile money is actually growing at around about just over 30%, and that's a key driver for the business further down the line as well. So I like that it's in the telecommunication space, but also that it's got a mobile money platform that's a bit like PayPal is also really impressive. It trades at 8 times earnings, which I think is incredibly cheap when you look at the growth of this company. Maybe it does trade a little bit cheaper because of the potential political risks, but even given that, I think that this should be trading in the teen range earnings. It does pay dividend yield. Dividend yield's pretty healthy at 3.7%, and I've been recently put off buying Airtel Africa. When we've entered 2022, we've seen a lot of stocks, be crashing, and Airtel Africa just didn't have that happen. It held up, and in fact, it was having a pretty good year. Really though, since July, when we've seen a lot of small caps and mid caps start rallying, this has, funny enough, gone in the other direction, and it's now down 26%. In fact, I think it's a little bit more than that. Let me redo that. 29% down now from where we topped out in July time. So now that this is finally having a dip, and I've been waiting to buy this for a while, I'm taking the opportunity to buy it. I am averaging up a little bit, and I probably won't buy again until it goes a little bit lower. But now that it's finally having a dip, and I think that at 8 times earnings with a 3% dividend yield is a pretty attractive opportunity to be looking at. And the one big thing that I always had the worry with this business is the financial health of it. It always used to be when I started buying this, over 2 years ago now, the only little concern I had was it was quite debt heavy. But what they've been doing now is, because they've been generating really good amounts of profit and revenue growth, as you can see here, and should continue in the high single digit range, they've actually been able to now start paying down some of the debt. So they've gone from 100% debt to equity now to a place where it's 55% debt to equity. So that's even better. And also the dividend is pretty secure as well. You'll be able to see here that it's currently a 30% payout rate. So there's not really much risk to the dividend. In fact, there's a lot of room to keep upping that dividend, especially when you keep growing at the rates that they are or have been doing previously, which has been super impressive. So yeah, I did buy some Airtel Africa. Now onto a little bit more of a risky one. I did buy some Asos. Now Asos is very much like a Boohoo situation where we're waiting for the boom of the CV to die down, we're waiting for logistic issues to calm down, a lot of the inflation pressures that are going on, and I've been standing off Boohoo a little bit. And you'll probably be thinking, well, why am I buying Asos over Boohoo? I'm a bigger fan of Boohoo than Asos, 100%. I prefer that they own a lot of their own brands. The thing that I have with Asos is that it's just gone so low now. Like, this has now gone back to levels it was at in June 2010, which is unbelievable. June 2010, so 12 years of share price performance wiped out this business. And eventually I just got to the point where I was like, I'm just going to add a little bit in here just because of how low it is. Like for this stock to, fall down nearly 90% is just unbelievable. So obviously Asos, I think everyone knows the brand. I think they're here to stay. People are always going to be shopping for clothes. Hopefully them adding in the top man part of it gives them some better margins as well. And when you look at the performance of the business previously, it's been absolutely amazing. But at the moment, they are just going to hit a bit of a blip. But going forward, I think when we go past, into 2023, we should see Asos, return to a good 5-6% levels of growth. And then we start adding in good amounts of profit. If we start adding in, 50 million back into profit, if we can push towards 100 million in profit, which is nowhere near where they were at pre-problems that they're starting to hit at the moment. If they start hitting, nearly 100 million profit at 754 million market cap, growing at a good 4-5%, that's a really good opportunity in my opinion. So I thought I'm just going to have a little bit of a nibble here. So I thought I'd buy that one just because of how low it's gone now. The next one was National Express. So I've been buying this one as well for around about 2 years. And since around that April time, this stock's gone down 42%, and it's actually really close to the levels it was at in the the pandemic time, which are like, how is it even at these sort of levels? Because when you actually look at National Express, they're actually posting in very good financials at the moment. If you look here, they've just put in revenue up 33% year on year, and it's actually 5% of 2019 levels at constant currency. So this business is basically at where it was at pre-pandemic levels. And the share price just has no reflection at all. In fact, it's nearly at pandemic lows, even though this business is starting to really come into a bit of a positive direction now. And National Express has really been doing well because they've won a lot of contracts in the last few years. Them contracts are now starting to add into the profit and now starting to add into the revenue. And we're seeing that financially starting to perform very well. So if we look at Simple Wall Street here, you can see the impact on the revenue and profit that the CV situation had on it, but you'll see here now the revenue is starting to move back into that positive direction, and we should be somewhere near that 2019 level by the end of 2022. And you'll see here that the profit is not near where it was the pre-pandemic level, but we should move into a positive direction now. And if we can start pushing back into 100 million profit, even at 50 million at a 1.1 billion market cap, I think this is a very good opportunity. And same again, I think we'll see this business grow around 3-4%, good amounts of profit. Further down the line, it'll hopefully just sort the balance sheet out a little bit and make it a little bit stronger. But then it should return to a potential dividend yield. And depending on what that dividend yield is, if we're talking about the same sort of levels it was at in the pre-CV situation, we'll be picking up a dividend of around about 3-4%, which obviously is pretty attractive. So yeah, I think that we'll be talking about this stock, doubling in the next few years, picking up a very good dividend. So I've been buying up some National Express. The next one was Barrett Development, so a house builder. House builders are obviously getting a bit of heat at the moment. But the thing is you'll look at the moment and you'll think, okay, the news is that it's getting worse, the housing situation, but the stock's been bouncing up recently. It's up 17% since October. The reason why is because all the way from April 2021, we were pricing in a housing market crash. Barrett Development is already down 56%. People are already pricing in a housing market slowdown back in April, and people have really priced in now that potentially you're looking at Barrett Developments getting hurt because of the interest rate situation, which it will do, but a lot of it's priced in. And you look here, it trades at 8 times earnings, the dividend yield is around 9%. People are already looking at this and going, okay, we're going to price in that dividend getting cut by about half. And that's why it's lost half its share price, because people are pricing in around about 4-5% dividend yield already. Now, my big thing is that we potentially could see a dividend cut in Barrett Developments. That would not surprise me. But I think that what's being priced in is way too much. You look at the dividend here, the company does good amounts of revenue, good amounts of profit, and that might get hit a little bit further down the line. But the financial health of the business is really good. It sits on a cash balance of 1.4 billion. And you do look at the dividend yield, and it's currently a 73% payout rate, so they've still got a bit of room there. But Barrett Development is obviously going to have a bit of an impact in this next 12 months. But further down the line, 12 months down the line, you're probably going to look and think, well, inflation's probably peaked by then. It's probably coming down. If inflation starts peaking and coming down, what's going to happen is interest rates are going to come down. Interest rates comes down, people are now going to step back onto the property ladder, take up some of the housing discounts that have happened, with house prices falling 10-20%. And because people have been not able to get mortgages at 6% and then they come back down to a 2-3% rate, even 4% rate, there's going to be a build-up of people wanting to buy homes. And then we're going to be talking about in 12 months, there's a housing market explosion because people finally can get mortgages, people have been saving up, and also house prices are a lot cheaper. It's going to be a good situation for Barrett Development. So I think that there's going to be some short-term pain in Barrett Developments, but I think that's very much priced in. And if anything, when you look further down the line, I think we could be set for a boom here. So and the last one is legal in general. So this is just a very safe, kind of boring, does its thing, doesn't have much shock in the share price. Dividend stock. So it trades at 7 times earnings. It's never going to be a crazy valued stock because of the sort of company that it is. But I think that normally it would trade, towards a 10-11 times earnings. Pays a 9% dividend yield. Same again, I think the dividend is pretty secure on this one. They pay a low dividend payout rate. Very safe on the profit side of it. And it's not a stock that you'll ever expect this one to, double up in the next 5 years. But realistically, on a share price point of view, I can easily see this in the next 5 years going up 30-40%, as well as being pretty safe on paying that dividend yield. When you're talking nearly a 9% dividend yield, the average return of the S&P is 8-9%. So you're basically getting nearly what the average return of the S&P is at this sort of dividend yield. And then without factoring any share price performance, which I think you'll get with it, you add that on top. It's a pretty safe, boring stock that I really enjoy having in the portfolio. So I did nibble at some legal in general when it had a bit of a dip down here, as you can see. But since then it's been on a little bit of a rally, but I bought some in that little bit of a dip. So those are the stocks that I've been buying in the last few weeks on the UK side of it. If you want a bit more information on any of these stocks, I should have a video on the channel where it's a little bit more in depth. If not, it should be on the Patreon and it should be on one of the stock request videos that we do. So if you want a bit of a longer video and a more detailed video, that's a place to check it out. But those are the UK stocks anyway, guys. Hope you enjoyed the video. If you enjoyed it, make sure you smash the like button, and if you're new around here, subscribe, and I'll see you on the next video.